Why was the South Sea bubble a warning for bond markets? Imagine a time when people believed that investing in a single company could make them rich overnight. That was the scene during the South Sea bubble of 1720. It was a financial storm that showed how risky and fragile markets can be when speculation runs wild. This event is a key lesson for how bond markets and financial systems develop over time. The South Sea Company was created to manage Britain's huge national debt by turning it into shares in the company. Investors were told they could make big profits from trade in South America, but those promises were mostly false. Spain controlled the trade routes, and treaties limited the company's potential. Still, people bought into the hype, pushing the stock price from about £128 to over £1,000 in just a few months. This rapid rise was driven by hype, insider deals, and the belief that prices would keep climbing. When reality caught up and trade prospects proved poor, the stock suddenly crashed. Many investors lost everything, and the government's credibility took a hit. The collapse showed how dangerous it is when markets are driven by speculation rather than real value. Looking at this from a bond market perspective, several lessons stand out. First, it revealed the danger of mixing government debt with speculative investments. When government bonds are converted into company shares, they can become overvalued if investors are betting on unrealistic gains. This can lead to unstable prices and financial shocks. Second, the event highlighted the need for transparency and regulation. The bubble was fueled by fraud, political corruption, and lack of oversight. Clear rules and honest information are essential to prevent manipulation and protect investors. Without them, markets can become a playground for greed and deception. Third, the South Sea bubble showed how investor psychology matters. Herd behavior and mass enthusiasm can inflate prices beyond what's justified by economic facts. This kind of mania can cause sudden crashes, which are harmful to everyone involved. Fourth, it demonstrated how interconnected debt and equity markets are. Problems in one can spill over into the other, making it vital to manage public debt carefully. If government bonds become unstable, it can shake confidence in the entire financial system. Finally, the collapse had real economic consequences. It caused bankruptcies, loss of trust, and slowed economic growth. This underscores why stable, credible bond markets are essential for supporting broader economic development. The aftermath of the South Sea bubble led to reforms like the Bubble Act, which aimed to regulate joint stock companies and prevent similar crises. It also influenced the development of financial institutions and market rules. Today, it remains a clear warning that financial innovation involving government debt must be managed with care. When speculation and poor governance take hold, markets can quickly turn chaotic. For bond markets, this story reminds us that managing public debt and maintaining investor confidence are key to avoiding future crises.